Luke, it's a pleasure having you on my show. I was really looking forward, and I never show other books on my channel, only my books, of course, but I have to. Guys, all my followers, if you have something to read, or if you have nothing to read, you have to read those two books. It's a deep dive into the macro views of Luke, and it's just a great read. I definitely recommend it, and I will definitely put a link in the show notes. And you published them in your own on your own name, or didn't you? Or is there a company behind? No.
Yeah, I basically published them, self-published them, basically. Exactly. That's right.
Okay, perfect. So guys, I never do that, but this time you have to buy these books and you have to read them. It's definitely worth it. I highly recommend your books, Luke. So how are you today?
I'm doing great. I'm very excited to be here. I as we were talking about before the show, I think this is the first show I've done with a German audience, and as I was like I was saying to you before, I'm actually of German descent. My grandfather's family on my dad's side moved to America right around the turn of the century. In fact, my grandfather's oldest brother was born back in Germany. So my grandfather was fluent German speaker, spoke German often. I took 5 years of German in high school and was starting to get decent at it. And then I went to college and I let it all go to pot, unfortunately. So, you know, like you were saying, maybe we'll just keep doing future ones and eventually I'll work up to ein bisschen auf Deutsch.
Sehr gut, sehr gut. Ja, wir können es auch jetzt in Deutsch weiter fortführen. No, just kidding.
You can see my face going, oh no.
The end. No, but have you ever been to Germany?
I never have. It's someplace I definitely want to. Oh yeah, I'd love to.
If we ever are allowed to travel, you know, you never know, perhaps it's over now, but you're very welcome. You just give me a buzz and then I give you the greatest tour ever. So you will.
We will definitely do that. That sounds terrific.
Yeah, it's not superficial. I really mean it. You know, you can ask other people, ask Grant or somebody. I do it. Okay. So perhaps you tell our listeners who don't know you yet, but they will after this conversation, something about your background. What's your background, where you're coming from, and exactly why did you write those books?
Sure. So my background, I started off in investment research back in the mid-90s with a regional brokerage firm or a boutique research brokerage firm in Cleveland, Ohio in the United States. And we were pioneers in deep bottoms-up channel check research. So we were talking to distributors, suppliers, just putting together a mosaic to try to determine which stocks and industries were good or bad investments. So I was with a firm called Midwest Research from 1996 through 2006. I was a partner there. We sold that business to First Tennessee Bank in Memphis in 2001. 2006, myself and about 20 partners launched a new research firm called Cleveland Research Company. We were doing a lot of the same type of in-depth research. In both of those roles, I was a founding editor of a weekly summary piece where I put together both this interesting pieces of research we were discovering from the bottom up and marrying it with a top-down thematic view based on reading I was doing on my own time. And these weekly Friday pieces became extremely popular across Wall Street, tens of thousands of readers. And so those, in addition to our research, obviously helped our client base position very well for 2008. And so on the other side of 2008, I was doing a lot more macro and thematic type work for the accounts I called on for the firm. And by 2013, I said to my partners, I want to do focus on the macro full time. And they said, we'd love to have you do that. And I said, my one caveat is I want to have complete creative control to write whatever I want to write. And so from a marketing standpoint, we had a difficult time kind of figuring out how we would position that, given that we were known for this deep in the weeds, bottom up fundamental research. So we parted ways amicably. I hung out my own shingle in 2014 as FFTT, which stands for Forest for the Trees. And what we do is aggregate a large amount of disparate or publicly available information from disparate resources And we're trying to identify developing economic bottlenecks. And what I mean by that is my 25 years of experience indicated that those industries, those companies that are set to benefit from or be hurt by an economic bottleneck developing tended to outperform. And so we're looking for sectors. We don't cover specific companies, but we do macro and thematic and industry sector type level looks into different developing economic bottlenecks. And so we're coming up on our 7th year, and it's been a great move. It's been an absolute blast, and never could have imagined, for example, here I am talking with somebody in Germany about macroeconomics. It's really a dream come true.
Yeah, that's a proof that you're doing a great job, But you said 25 years of experience. So you started with 6 years?
So I said, you're very, yeah, I'm actually like 70 years old. That's why the hair's all gone. It's,
No, but seriously, you have to tell us your secret. You look like 25, man. Look at me. I appreciate gray hair already. It's all the macro shit.
So you still have yours. If I let mine grow out, it would be gray, and the little that I had would be all gray. And fear not, you're doing great.
Yeah, you lost all your hair because of the macro and because of the books, of course. So what was your motivation to write those books?
Sure. So I had a client of mine, one of my best relationships on Wall Street, reach out to me and say, you should do a report in the Socratic method where you're asking the question and answering the question. To really kind of give yourself the latitude to flush out some of the issues you're talking about. And because our reports tend to be very fact. We establish fact patterns, and then we say, okay, there's this potential range of outcomes based on this fact pattern. And so it doesn't give a lot of leeway for, well, maybe why someone's doing this or why someone's doing that. And so this client of ours said it would give you a lot more leeway to just sort of free flow with the thought process. And so I said, that sounds like kind of an interesting idea. And so I sat down and I wrote out, and once I started writing, it literally 3 or 4 hours went by. I had probably 30 pages written out, and it just flowed. And that was really like the first chapter of the first book ended up being. So that ended up being a report for our clients back in 2016. And then I periodically, when I wanted to explore an issue with a little bit more freedom, really, I guess you'd say, I would end up writing one of those reports to just sort of brainstorm. And I don't know, about 2 years into it, somebody said, you need to put those out as a book. And so I said, okay. So I started putting them all together, and I hired an editor, and editor said, hey, this is great. Let's do this. And so it's really just been the aggregation of a series of reports that we put out prior for some of our clients that just kind of explored a thought process for a lot of things that are really going on that are pretty at times confusing, and trying to figure those things out.
Yeah, you did a great job. I really have to recommend your book again to all my audience. So the first topic I want to talk with you about is the US dollar-centric system. Look, can you break down how the current monetary system works for our followers, for our viewers?
Sure. So you probably, and this is going to sound, some of your viewers are going to go, oh no, it goes back to 1946, but I'm going to be really fast. So you go back to 1946, in the aftermath of World War II, there's a meeting in Bretton Woods in the United States, and there are two proposals. There's the John Maynard Keynes proposal, which was basically a neutral settlement asset. It's something he called the Bancor, where you would have trade would take place, and the trade would get settled in bancors effectively. When one currency got too strong or ran too many deficits, their currency would weaken relative to the bancor. The country with the surpluses would strengthen, and it would be a self-correcting system. And so that was Keynes's view. The United States had a different proposal, and it was the dollar at the center of the system. The dollar pegged the gold at $35 an ounce, and everyone else pegged to the dollar. And we won. Ultimately, the better system, I think de facto, would have been the Bancor. China has said this in the last 10 years. It would have been more sustainable. We probably wouldn't have had some of the crises, but realpolitik won out. The United States had the most undamaged industrial capacity. We were the biggest oil producer. We had the biggest army. We had all the gold.
And we won the war.
Yeah, we won the war. And so we got our way. And so this system was chosen. And so that was, when you look at 1946 to 1971, we had a dollar-centric system where the dollar was the global reserve currency, but gold was ultimately the global reserve asset when you had imbalances, but it was at a fixed price, which ultimately led to the strains. We ran deficits associated with Vietnam and associated with Lyndon Johnson's Great Society, and some of the nations that had been damaged during World War II, Germany, Japan, who tend to be very productive, got back on their feet, got back to being very productive, went from being deficit nations in the immediate aftermath of World War II to being surplus nations again. And so there were these fundamental strains between sort of true creditor nations, just culturally, industrially, Germany, Japan, a couple others, wanting their gold relative to the deficits the United States was increasingly running. And those strains came to a head in 1971 when Nixon took the United States off the gold standard. And it was a huge fundamental change from the standpoint that from 46 to 71, we had a system where the dollar was a global reserve currency, gold was the global reserve asset. Post 71, we now have a system where the dollar is the global reserve currency and the treasury bond is the global reserve asset. We effectively made the treasury bond as good as gold and proceeded to issue them like crazy. And you can see this in all the charts. They all hockey stick up.
What happened in 1971,
It's all 1971. And to be clear, there are some elements that were good about it from the standpoint of we were in the middle of the Cold War with the Soviets. We weren't exactly winning at that moment. And so I make the argument that we basically won the Cold War at that moment because the Soviets had to raise oil out of the ground to get the hard currency to fight the Cold War, whereas the Americans could print the dollars to get the oil, and it's much easier to print dollars than it is to pull oil out of the ground. And it's a vast oversimplification, but ultimately, over the next 18 years, we win the Cold War. We probably should have had a monetary conference in 1989 when the Berlin Wall came down, when the USSR broke up, and said, okay, this system worked for us to for the purposes. But now we need to sort of rebalance the system, new monetary conference. That didn't happen. And instead, what happened is the United States sort of doubled down on the unilateral, as a unilateral power, and Treasury issuance continued to grow. And so you've got this system now, the dollar-centric system, where it really is from 1971, I say through 3Q14, when you had the dollar as a reserve currency and treasuries as a global reserve asset, and that has created some very big fundamental problems that I think are now coming to a head, as described by Robert Triffin.
Yeah. And I ask you this question because I think it's essential to understand the monetary system, that banks can create money out of thin air. In Germany, we get never taught this in school. So this is why I ask you this question. It's so important to understand how money comes into the world, how it is created, and how you can protect your purchasing power for the future. So in your book, you do a fantastic job, actually. You're pointing out that something changed in 2008 in the global system. I think it was definitely a game changer because since then, we see globally that people lost trust into the system. And you even claim the global currency system is undergoing the biggest change in the last 50 to 70 years. And I talked with Grant about The Fourth Turning, the book by Neil Hall and Strauss. Perhaps can you elaborate this a little bit for our audience?
Absolutely. So I think 2008 was a huge moment, and I think it really was an acceleration in that book, The Fourth Turning, in The Fourth Turning. Historically, when we transitioned from gold as primary reserve asset to treasuries, I think there were certain aspects of it that people didn't like, but ultimately America did a decent job of managing that currency system for the good of all. And quite frankly, the existence of the Soviet Union, it served as a counterweight. We couldn't get away with that much in terms of really abusing that currency system. I think after the Soviet Union broke up, once we became unilateral, we started to abuse the currency system more and more to our advantage.
Yeah.
But I think even up to that point, I think much of the world thought, well, when push comes to shove, and the U.S. is forced to choose between managing the dollar system for the good of the world or managing the dollar system for the good of the United States, which was the fundamental collision that was always going to happen once, after 1971 happened. I think most of the world thought we would manage the currency system, manage the dollar for the world rather than for the United States. And when 2008 happened, if you look at the problem, it was really a problem that much of the world had seen. There's a great article that was written in 2009 called The Quiet Coup by Simon Johnson, and we refer to it in the book. And Simon Johnson was a former chief economist of the IMF, and what he said about the 2008 crisis was, I've seen this over and over. I saw this in Latin America in early 2000s. I saw it in Southeast Asia in the late 90s. I saw it in Russia in the late 90s. And it's a very clear balance of payments, banking system crisis. And the recipe to fix it when the IMF gets involved is always the same. We come in, we implement austerity, we make these draconian changes to the oligarchs within that society, and we basically put them back on a sustainable path, and away we go. And so when the United States befell the same crisis, that was the choice. Do we manage the dollar for the world, or do we manage it for the United States? And we managed it for the United States. Instead of doing all these painful things, we printed the money. Yeah. And I think that was a huge wake-up moment, a huge acceleration in the fourth turning, because I think it was for the creditor nations of the world, China, Japan, Germany, OPEC, Russia, I think it was jaw-dropping to them. I think they looked at this and said, okay, they're printing $3 trillion, that's fine, but they have these entitlements. The United States owes $100 to $200 trillion in entitlements to its baby boom generation and beyond for Social Security, Medicare. And we were always under the impression that they were going to reform those. They were going to cut those. They were not going to print that money. But now, oh my gosh, I think they're going to print all that money. And the problem with the system as the way it's structured was one of the core underpinnings of the 1971 system was oil was only priced in dollars. And so basically went from a gold-backed dollar to an oil-backed dollar in some fashion. Well, if the United States, we saw it in 2008, the U.S. printed $3 trillion, and give or take, and oil went from $40 a barrel to $110 a barrel. If the United States, I think these creditors took a step back and said, if the United States prints the $100 trillion for entitlements, oil is going to go to a price that crushes our economies. And I'm specifically referring to those creditor nations and creditor regions that are oil importers, energy importers. So Germany, the European Union, China, Japan. So basically, we would be putting Germany, Eurasia, China, Japan into a currency crisis if, and after 2008, I think these nations all said when the United States prints this money. So I think 2008 was a really big acceleration in this fourth turning, this currency system change. And the currency system change that began being implemented as a result of this was you began to see for the first time the creditor nations moving to price commodities in their own currencies, that basically as a way of getting away from the dollar. Because if you look at what the deficits, if you look at Germany, for example, you guys run you're a creditor nation in pretty much everything except for energy and commodities. China is a creditor in pretty much everything except for energy and commodities. Japan, same story. And so you started seeing these moves to make a major change to what had been the dollar-centric system, a key tenet of the dollar-centric system post-1971, which was oil is only priced in dollars. And you started seeing Iran, Venezuela, Russia moving to price oil in yuan, in euro, as a way, in my view, as a way of beginning to prepare for the eventuality that the Americans would have to print $100 to $200 trillion. And so I think that '08 moment of the realization was a huge moment and a huge acceleration in the fourth turning.
Yeah. You think the US dollar, the days of the US dollar are numbered? You think they are already prepared for another monetary system in Russia, in China?
I think they're close. I think the central bank digital currency system that China is rolling out is a very, very big piece potentially. One of the big things that people have always pushed back to me, rightfully so, has been they can try that, but in the end, everything still has to flow through the SWIFT system. And we saw that in 2012. We kicked Iran out of the SWIFT system and essentially hyperinflated their economy. The problem with that is that we identified to China and to Russia that we would use that weapon. And I would argue it was a bad idea.
They don't like it. They don't like it.
No, I'm sure they don't. I mean, and so I think that was really a hallmark to them to say, okay, 2008, they saw us print the money and said, all right, well, we probably need to move. Well, then when we put the SWIFT sanctions on Iran, then I think things went into hyperdrive. And you could see that by 2013, the Chinese said, we're done buying treasuries. 3Q14, global central banks stopped buying treasuries on net in total. But they still, that SWIFT system was still, even though they knew it was a threat, there was nothing they could do about it. But now when we talk about these central bank digital currencies, they increasingly, to me, look like a way that China, Russia, and others can circumvent the SWIFT system. And once that happens, I think the rest of the infrastructure in terms of local currency trading, I think the neutral asset that they are settling in is gold. I think that's what they've chosen, at least for the near term, except at a floating price. I don't think they're going to make the same mistake that we made, which was to peg the price. And so I think they are it's largely ready to go. I think one of the key things to watch going forward is the pace of development of the central bank digital currency globally, but particularly in China with this new trade deal, especially they just signed the RCEP.
Yeah, I think we both agree that the US dollar is actually a weapon, and the government in the US, they use it, and Russia and China, they have enough of it. They're like, okay, that's it. You just, bend it too much, and it's over now for us. So we create our own currency, and I see the same way. And then we have the trade war between China and the US, and many people, especially in Europe, think Donald Trump started this trade war, but this isn't actually true, I think, because China started the trade war like 20 years ago when they got a member of what was it?
Oh, the WTO.
Oh yeah, exactly. Yep. When they got a member of the WHO, and this gets never discussed in the media. So what's your thought on this?
Yeah, I look back at it and I think it ultimately, it's kind of the story of global politics, right? You go back, this pattern repeats over and over. It's sort of a Game of Thrones type of thing. But I think ultimately, a lot of it ties back to that 1971 time, right? We couldn't make good on our obligations because we had made poor choices vis-a-vis Vietnam, and we'd abused the dollar. Okay, so we closed the gold window. You can go back and read at the time, the European community at that point started having meetings about coming up with their own currency to get away from this system, because the dollar system as structured basically made Europe an economic vassal of the United States. Secretary Connolly famously said, it's our currency, but it's your problem. And I think the Europeans said, all right, well, that's fine. You're right. For now, we're gonna work to change that. And so I think it ultimately is all about the financing of the United States deficit when you take a step back since that point. And so what I mean by that is Europeans, and to a lesser extent the Japanese, were financing U.S. deficits through the 70s, the 1980s, and even into the 1990s. I think we have I may even have the chart in one of the books. But if you look after the launch of the euro in 1999, the Europeans effectively stopped financing U.S. deficits. Yeah. Basically, all those all those German surpluses stopped being recycled into our debt, and they started being recycled into Southern Europe debt, which is a whole separate issue, but
still shitty.
But it wasn't flowing to us. It was the most important thing as far as the Americans were concerned. And you can see then, so what we've said is, and I say this tongue in cheek, but the Americans needed a new sugar daddy. We needed somebody new to sponsor us.
And new bitch in the town.
Exactly. So we get China into the WTO, and the deal effectively was, listen, you take our jobs, you take our factories, you make stuff, you sell it back to us, and we will send you dollars, and then you will recycle those dollars back into U.S. Treasury bonds, U.S. mortgage bonds, and other financial assets. And so it enforces this hollowing out of the United States manufacturing sector. And again, it was ultimately, people want to say, well, China started or the U.S. started it. And I think it really comes down to the U.S. has refused to get its deficit spending under control for 50 to 70 years because of where we started the 1946 period. We've never had to. And, so the reality is China, when that deal was launched, owned $60 billion with a B in treasury bonds in 2001. And by 2013, they owned 1.3 trillion in treasury bonds. You can see U.S. manufacturing employment from the time China went into the WTO. It fell by, I want to say, 5 million Americans in 3 or 4 years. It was incredible. It was an absolute hollowing out. So again, it was really, was China to blame? Was the U.S. to blame? They were both to blame, in my view. China was willing to basically be disciplined, save their money, under-consume for an extended period of time, and gain the industrial capacity of the United States as an offshoot. And the American policymaker political class was willing to make this trade to accomplish what they saw as important policy goals. And so on one level, it was no question, it ended up being very bad for the American middle and working classes. But again, part of the problem is policymakers had made these promises to American middle and working class that they couldn't make good on unless they did this. So it really was just this evolution of the system that ultimately put the U.S. and China, that set up this trade war. But this was a long time in coming, and I think it ultimately goes back to just the flaws of the system itself as it's been structured since '71.
Yeah, and the US deficits got worse and worse, especially with Corona. It's just like, if you look at the charts, it's like parabolic, actually. The Fed balance sheet looks horrible. We're over $7 trillion. And I just read the message, I think it was on Twitter or somewhere, that I think 60% of the dollars were printed in the last 12 years and 21% in this year. This is crazy. This is just crazy. Are we in the end game?
I think we are. And to me, I think the end game started last fall. So fall of 2019 with the repo rate spike. So what you can see is this progression. So in 1971, the Europeans were saying, we don't want dollars, give us the gold. And we said, okay, no more gold. Okay, so then we changed the system. And that system migrated. So then they launched the euro. The Europeans say no more treasuries. So now we need a new financier. In comes China. China finances us for a while. 2013, because of what happened in 2008 and 2012, China says no more treasuries. Now the United States goes, we need a new financier. And there's no one, who is it? It's not Africa, because it's maybe India, maybe something, but America needed somebody that would finance $500 billion to $1 trillion a year in deficits for the U.S., and there's no country generating those kind of surpluses on the other side. We're way too big. And so the answer is Mars, Jupiter, or the Fed. And now, ultimately, in the short run, from 2014, 15, 16, the United States took a series of steps to try to finance these deficits itself. We regulated the U.S. banking system into buying more treasuries. We regulated the U.S. money market fund industry into buying more treasuries. We implemented under Obamacare, if you take a step back and see the forest for the trees, was really a tax hike, a way of trying to push the government's healthcare costs onto the U.S. consumer. We did all these things to try to make it work, but ultimately it didn't work. You could see deficit as a percent of GDP begin rising again by 2016, which had only happened 7 times in the prior 50 years, and we're always an indication of either a recession or a significant dollar devaluation. And so it was by late 2016, it was becoming increasingly apparent either the dollar was going to have to be weakened or the Fed was going to have to grow their balance sheet, one or the other, or both. And in this, you could see by late 2018, the U.S. banking system was beginning to choke on how many treasuries they were having to buy. They were being crowded out. Fed funds rates was rising above interest on excess reserves rates, which just basically meant that the U.S. banking system was having to buy so many treasuries. They were driving rates up, borrowing rates up amongst each other. They were crowding themselves out. And some of these banks were borrowing funds in repo markets to help finance this. This all came to a head in fall of 2019 when repo rates spiked to 8 to 10%, which would have been absolutely catastrophic because ultimately the repo rate is your reference rate in the U.S. Whatever you're financing, whatever your interest rate is, it's repo plus a spread is how it practically works. So had the Fed not begun regrowing their balance sheet in 2019, you would have had treasuries at 8 to 10%. You would have had mortgages at 10 to 12%. You'd have had corporate debt at 11 to 13%. Everything collapses. So that was simply not going to be, and you could see what a risk it was because the Fed acted like that. The Fed acted in 48 hours. They got those rates right back. They panicked. They had to. Yeah. And to me, I think that was the real kickoff to the sort of the final end game, of course, right? Nothing ever truly ends, but in terms of this significant dollar devaluation, this rebalancing that needs to take place of the system through the dollar, because that was the moment where U.S. deficits, the Europeans aren't financing us enough, the Japanese are not financing us, the Chinese are not financing us enough, the banking system isn't able to finance us enough anymore. The Fed has to step in, and that's what began happening. And of course, now with Corona, it was completely unforeseen, and it absolutely, to your point, it blew the deficits out in a staggering rate. So one of the metrics I look at is as a measure of where we are in this process of the sustainability of the U.S. fiscal situation is the big 3 expenditures. So the things we spend most money on, it's entitlements, which is Social Security and Medicare, defense, and interest expense. And so back in 2016, we wrote a report that said those big 3 were about 85% of U.S. tax receipts. So getting up there. We thought it would be over 100% of tax receipts by 2021 or 2022. Well, because the Fed raised rates and because the economy slowed, we were at 103% in the third quarter of 2018. And after COVID, we're at 140%. I mean, it's irrecoverable.
Yeah, so exactly.
Now we're into this where we've made some changes to regulations for banks where they can buy treasuries. And they've taken off the capital restrictions to buying treasuries, which is sort of a classic emerging market move. But all of these things point to, again, we need a new financier, and the only obvious financier with enough balance sheet is the Fed, unless we are going to dramatically cut defense and entitlement spending, which to me seems very politically unlikely.
Yeah, I think so too. The thing is, the whole system is actually like a Ponzi scheme, It looks rigged, it's corrupt, and it will collapse. It's limited by math, and this is a natural law. So the question is, they try to keep it alive, and they're totally desperate. So the question is, how long can they keep it alive? And I guess we both agree, they will print more money. They will print till the end, and they will, of course, lower the interest rates. I expect, in the last book I wrote it, I expect negative interest rates. That's why they want to introduce the digital currencies, the central bank digital currencies, the CBDCs. So that's the next step in their game. But I think the end game is upon us. So what do you think? What's the time frame? Or do you think there is a solution to hold up, to heal the current system?
The solution would be some sort of, massive increase in productivity, economic productivity. So if somebody came out right now, exactly, if someone came out with basically the equivalent of say nuclear fusion, right, where all of a sudden energy is cheap and free and portable and infinite, then that's a solution because you would have a rapid increase and et cetera, et cetera. I don't think that's very likely, but I would be remiss not to identify that that is theoretically possible. Sure. That we get some sort of technological leap forward that we're not currently expecting. And that's something I watch for and factor for. And I'm not seeing it at this moment. But barring that, it really comes down to a choice. The policymakers have a choice. Do they want to lose control of rates on the upside, or do they want to lose control of the quantity of money? And the Fed was faced with that choice when repo rates spiked, and they chose. And so to me, it really is, I think we're now getting into that, like you said, the end game of these fiat currency systems where the debt is unsustainable relative to the balance sheet, relative to the pace of economic growth. And so they have to, we're seeing yields back up in America, for example, 10-year yields up to almost a full percent. To me, the $64,000 question is, when are they going to cap that? And that, to me, is where we really get into the next, into this sort of the next phase of this process that arguably began all the way back in 46 or 71 or 99 or 08. It's been a steady process, but I think we're getting down to, to brass tacks, as we say here, because at some point, yields are going to get to a level where they begin to restrict growth. And the problem with our debt levels where they are is if growth falls, you go into a death spiral. So that is simply not going to be allowed to happen. And they'll cap yields. And I've looked back numerous times, I reference it in the book, is the last time the United States was in this position was in the aftermath of World War II, where we had these extremely high levels of debt. And we had, for different reasons, but foreigners were not buying our debt, not enough of our debt. And what happened was that the Fed came out and said, in 1940, early 1942, said, we are going to cap 10-year yields at 2.5%, no questions asked. We're going to cap the 3-month Treasury yield at 0.3%. And that was it. And the Fed's balance sheet was the release valve. It exploded higher. And so as much as we've seen the Fed's balance sheet explode to this point, I think that's really just a warm-up to what we're eventually going to see in the next, I really think it's probably in the next 12 to 24 months because of the levels of debt we're at, because of the fiscal shortfall of the United States. Again, if we have some sort of big productivity-enhancing growth, a big recovery, there are some puts and takes to that. There are some things that could delay that. Sure. But the things that could completely stop it are pretty, I don't see them at all on the horizon at this point. So that to me is the next step of where the Fed just says, look, the 10-year is going to be 1.25. That's it, full stop. Or the 10-year is going to be 1.5. And I don't know what that number is. If I knew what that number, that's a very powerful number to know. It's a very important number to try to handicap as an investor, because that's the number where the announcement comes out and then the Fed balance sheet goes 7 trillion, 8 trillion, 9 trillion, 12 trillion, 20 trillion, as they're basically monetizing U.S. federal spending.
Mm-hmm. Do you think this will end? Okay, let me recap. Let me think again. The old monetary system is definitely in the end game. There will be a new monetary system, and normally this transition doesn't go smooth, because the US wants to keep the dollar, of course. They want to have the privilege to print all their debts away and be the most powerful nation in the world, and everybody has to be priced in dollar. Other countries see it differently. And normally when we see this paradigm shift and a new power occurs and gets in fight with the old number one, there is sometimes the chance of a war. And in the fourth turning, it's always a war, So you think there is a chance we will see a war?
Yeah, I think there's a chance. I don't assign a high probability to it for a number of different. I think, part of it is if there was a war between the U.S. and China, right, as the fourth turning the Thucydides trap book lays out, right, the rising power against the incumbent power. One thing that is truly different this time is this is the first time we've ever been in this situation where a quorum of the manufacturing base of the existing power is in the rising power's territory, right? So it's, I joke, and when people ask, are we going to have a war? I've sometimes responded only half jokingly, will the White House have to call, Tim Cook at Apple to ask permission to bomb the Apple factories in China before the war starts, which is, so I think, but I do think the economic war is ongoing, and it's kind of what we've been describing. I think it's very much at a head. This paradigm shift, I'm optimistic that if it's managed well, it doesn't have to lead to war. And part of that reason for that is within the United States, there is a group that wants to hold on to this status quo system. There's no question, and they are entrenched and they are very powerful, and they do have some valid points. However, there is what up until COVID was a pretty small group, but I think it's grown meaningfully. Another contingency in the United States, or another contingent, in the United States is realizing, and this is the case we make in the books, it's a case we've been making for a long time, is this dollar system that used to be really good for us is actually killing us now. Mm-hmm. It's gone beyond its marginal usefulness because we've had to hollow out our manufacturing base. And so when you go back to late 2018, the United States Defense Department came out with a very lengthy paper. There was a classified version and an unclassified version. And of course, I've only seen the unclassified version, but what it says is basically the economic arrangement with China and with the world has gone too far. We've had to hollow out too much of our manufacturing base. And if we had to fight a war, we might not be able to, because we can't make submarine, propellers. We can't make certain types of semiconductors. We don't have enough rare earth metals for the missiles without China. And that defeats the whole purpose, right? I mean, the first thing the American, my grandfather's generation, they came home from fighting World War II. The first thing they did not do was come home and offshore all of the U.S.'s manufacturing capacity to Soviet Russia to save 30% on labor costs. The reason they did that is they were political adversaries, right? So we now have a quorum of U.S. manufacturing in a political adversary to the point where it has hurt our own ability to fight a war. And the Defense Department raised this point in late 2018. They've really been raising the point for 10 years. They weren't getting much of an audience because the status quo system of, the dollar is the best thing to have, no problem. But I think COVID has changed that in some ways, because when we needed supplies, you couldn't deny it anymore. We were beholden to China. We had to check and see if we could get the supplies from China. So I think the COVID, as tragic as it's been on a whole number of levels, one good thing that came out of it was, when you look at these two groups in America, the group of, we need to keep the status quo dollar system and no matter the cost, I think that group got smaller, and there's a bunch of people went from that group to the group of people that said, look, this dollar system isn't really that good for us anymore, at least as structured. And that's something that we've been saying for a long time, that I've been writing about, has been my vision for where this is going, and where I think the preponderance of the evidence suggests it is going, is the system goes from being the dollar and then everybody else to the dollar is still a reserve currency, amongst equals, but that you reshift the balance, you reshift the currency system to being what it's been 71 to call it 2014, which was dollar global reserve currency, treasury bond primary reserve asset. You take away the treasury as a primary reserve asset and you put a neutral settlement asset there instead at a floating rate. So you basically go back to what Keynes was saying we should have done all those years ago. And I think there is a growing recognition in America amongst policy circles that that would be a good thing, the dollar system as it's been structured has run its course. It's gotten us into wars we can't afford to keep fighting. It's forced us to outsource our manufacturing base to an extent that is harmful to U.S. interests. It's causing domestic internal political strife. And so I'm optimistic that we don't have to go to an outright shooting war. But again, to not consider that as at least a tail risk, I think would be to ignore history, which is always a bad idea to do.
Definitely, definitely. So we both agree we need a new monetary system, and we can hope that this transition works smoothly. The question is, how could a new monetary system look like? What do you expect? Will we see, you already mentioned a gold standard, perhaps a gold-backed currency, or perhaps even Bitcoin, but we can talk about this later. So you really expect that gold will be money again, or that we have a gold-backed monetary system in the future, even if it's digital?
I don't think they're going to back the currency with gold. What I think it's a very subtle but important difference. Where I think the currency system is going is 71 to 14 was dollar global reserve currency, treasury bond primary reserve asset, all commodities priced in dollars. That were sort of the three key tenets of it. You can get into the euro dollar system and some of the things that help enforce that, but those are three key tenets. Where I think it is, and away from what I think, to me, the evidence suggests we are moving and have moved a substantial way toward is commodities priced in multiple currencies, yuan, euro, dollar in particular, maybe yen as well. But basically you price commodities in the IMF, SDR currencies, and then you settle any imbalances around those currency or around that trade. Commodity trade in particular, in a neutral reserve asset. That could be, in theory, I think it's gold, at least for the intervening time, at a floating rate in each currency. So no currency is pegged to gold. So you effectively end up pegging gold to commodities, basically, gold to oil. So instead of the dollar being pegged at $35 an ounce, as it's been, what you end up with is a system where the gold to oil ratio is pegged, and then everybody makes a decision on the relative how expensive they want their oil bill to be. But when you look at the global currency system, the biggest source of imbalances in trade are around oil and commodities, right? So Germany runs a big surplus on manufacturing, but a big deficit in commodities. Same thing with the Chinese, Japanese. And there's really only one nation that runs a big deficit no matter what. And it's us. Well, the British also run a big deficit no matter what, but ours dwarfs theirs. And so it basically, this system, if you price oil, I'm just going to say oil, so I don't have to keep saying oil and commodities. If you price oil in the SDR currencies and you settle imbalances in gold at a floating rate to start, what would happen is the currencies would re-rate based on their deficits. And if they re-rate based on their deficits, you would see the euro strengthen, you'd see the yuan strengthen, the yen strengthen relative to the sterling and the dollar. The dollar would weaken the most, but the re-rating of those currencies would be would make the system sustainable. And there would be puts and takes. So for example, if the euro strengthened meaningfully, German exporters would say, oh, this is killing us. But the trade-off is they would be able to print euro for oil, and their energy bills would be significantly less, which would help to stimulate infrastructure, stimulate a greater consumer class. Same thing with Japan, same thing with China. So it's the grand deal, I think, of the new currency system is you can't underprice your currency relative to the dollar and basically sell excess goods to the Americans. You're going to have to compete more with the Americans now. Or you're going to have to help them rebuild their infrastructure, which is also not a bad deal. But the quid pro quo is you're going to get the price. You're going to get to price oil in your own currency. You're going to have control over your energy bill for the first time since World War II. And I think when you look at what the Germans are doing, what the Chinese are doing, with the jet, I think that they're okay with that deal. I think they're willing to make that deal.
Very much.
You know, whether you look at Nord Stream 2, whether you look at some of these other types of arrangements, that is a deal that works out great for everybody. The American economy booms. The German economy booms. The Japanese economy. You guys will be selling infrastructure to rebuild America. You've got the Belt and Road. You've got, the reindustrialization of across Eurasia. It comes back down to who can be the most productive, and it gets away from some of the mercantilist behavior on both sides of the story that we've been through for the last 70 years. So the currency system transition, to me, I remain optimistic, can be this really good outcome where you have the rebalancing of this system ends up driving the biggest economic boom since the immediate aftermath of World War II. But to your point earlier, I'm also cognizant that if it's managed poorly, it could be the worst catastrophe since World War II.
True, true. Do you think the US or China will introduce a gold standard?
I have heard rumblings the Chinese would like to.
It's why they buy gold since 2008.
Yeah, they've got a lot of gold. I've heard from multiple credible sources that they are vastly underreporting their gold holdings, their official gold holdings. I think they say they have 1,800 tons or 1,900 tons. I've heard it's probably.
And I think they don't export any gold anymore. They just keep it in the country.
They just keep it in the country. And it's interesting. I love Bitcoin. It's very, I love Bitcoin. I love Bitcoin. I love gold. But if you watch what China's doing, you've got a lot of Bitcoin mining in China, and they have no problem letting that Bitcoin go out into the world. But that gold comes in.
Just wait.
they don't let that gold go out, right? So it's very interesting to me when you watch what people do, not what they say. And if you watch what the Chinese are doing, they're telling you they value gold more than Bitcoin at the moment.
Perhaps they didn't understand it yet, but after this interview, they will.
Exactly. So I think the Chinese are very big advocates of having a neutral reserve asset. I don't think they will make the mistake of pegging gold. Maybe they would, but if they're going to peg gold, it has to be at an extraordinarily high price. I think they understand that, where basically if you're going to peg it, you better make it high because you don't want to run out of gold.
Exactly. Yeah, sure. Sure. So, let's get back to the individual investor, and we accept the end game. I wrote in the last book, I expected till 2023 latest. You said next 12 to 24 months. So how can the individual investor or the audience prepare for the end game? What would you recommend? And on a short time frame, we always tell our clients that we have two scenarios. Yeah, first we will see a successful vaccine, and everybody will be happy, and we see a V-shaped recovery. And the second one is hard lockdowns, really hard lockdowns, and then perhaps we have a deflation, but on the long term, it doesn't matter actually. In the long term, we see. Definitely inflation, because there's so much money in the system right now. So what are your thoughts on the next 3 to 6 months on the horizon? You think we will have a V-shaped recovery? You think the vaccine will be there and it will work and people will get vaccinated? Or you think we will see hard lockdowns?
I don't know. I don't have a great feel on either way, but I'm definitely thinking of it in the same way, right? Okay. It's one or the other. If you get a successful vaccine, you get a recovery in economic growth. To me, that almost brings the end game forward faster, because ultimately you're going to get this bond market sell-off where it gets to, rates get to a point where it's going to force the Fed and other central banks to show their hand earlier. They're going to have to cut rates sooner. And so paradoxically, the happier or the more, the recovery outcome might actually put them under more pressure than the other one, because they're going to have to basically, and that is where I think it's critical to own gold, own Bitcoin. I prefer equities versus bonds in terms of they're going to, industrial tech equities. They're going to protect your purchasing power better, because you'd be looking at a situation where they've injected a lot of money. The interest rates are rising. The velocity of money is increasing because of the recovery. And then they have to, instead of withdrawing stimulus, they actually have to cap interest rates because they've borrowed so much. So now instead of taking away the punch bowl, they are pouring gallons of grain alcohol into the punch bowl, with their balance sheet rising even more rapidly to cap rates. And that's a scenario where I think you could see an absolute melt up in equities, a melt up in gold, a melt up in Bitcoin. And I think that's way more likely than virtually anybody thinks at this point. I think that's sort of where we get to 6 to 12 months out under the vaccine recovery scenario. Under the lockdown scenario, it's weird. I think we get a brief period of deflation where basically nothing wins but the dollar. But I think it's very, very brief, even briefer than what we saw in March, because we've already all seen it. Everybody knows, okay, I've seen this, great. I know they're going to have to come in and they're going to have to grow their balance sheet like they did in March, which the United States, the Fed grew the balance sheet at a $20 to $35 trillion annual rate for 2 months. And so they know that that's on the playbook. And so I think I wrestle with, do we get that period of deflation, which is my base case, in the case of another severe lockdown, do we get the deflation for a bit, which I think is, but I'm also, there's minority view of mine is, maybe we just skip over the deflation part. Maybe the hard lockdown, everyone goes, okay, here comes the $35 trillion annual rate again. Buy me stocks, buy me. And you could see stocks and gold and Bitcoin melt up under that scenario. It's really fascinating because it's something that I think Americans don't have a lot of context with, but as Germans, something I've been saying a lot, I think your audience will appreciate maybe more than American audiences do, is the world is in the first global sovereign debt bubble since after the immediate aftermath of World War I. And if you look at what happened in the immediate aftermath of World War I, you had the 6 big industrial powers, the US, the UK, Germany, France, Japan, and Russia. And if you look at the sovereign debts of those 6 nations over the next 12 years versus gold, the sovereign debts of those nations fell 75 to 100% over those 12 years. Germany obviously famously hyperinflated, Russia hyperinflated, Japanese nearly hyperinflated, and the US, UK, and France all devalued their currencies relative to gold by 75% plus. And so there are elements when you look at US specifically, but the Western world more broadly, these social democracies have made these promises and these demographic are what they are. There's a lot in common with the German war reparations after World War I, where in particular the US, our industrial capacity has been hollowed out. Back then it was because of the conditions of the end of the war, but now it's because we've offshored it to China. We have these inflation adjusting reparations that we owe to our baby boomers, and we're going to print them. And so it's not a perfect analog, but to me, when you think about first sovereign debt bubble, global sovereign debt bubble in 100 years, and then you lay out one of these 2 scenarios, recovery, hard lockdown, you end up at the same place, I think, because of some of the same reasons. It's this bursting global sovereign debt bubble that is really the driving factor to keep in mind. Like you said, that's really the end game.
Yeah. So it doesn't matter what happens. Actually, in the long run, you are just safe with real assets, I guess. We both agree on that one. Perhaps I just give you some assets and you just tell me what you think about them, and perhaps with a price target as well. So let's start with cash.
I think you want to hold a little bit of cash, but as little as, basically my view on cash is I want to stay just slightly more liquid than the US government. So basically I know as soon as the US government runs out of money, they're going to print it. So I want to have a little bit more cash than the US government and not a bit more. Now that's a tough number to get to, but that's, call it 5% in cash or something that you need, basically.
Okay. Yeah, just keep some powder dry for deflationary shock, perhaps, and then you can buy real assets for the paper money. Okay, perfect. Real estate, most Germans love to own their own house and buy real estate. And we have a bubble. We have here a melt up at real estate prices. They are incredible. They just doubled in the last 10 years. And it was never more expensive to buy a house. And the most people can't afford it anymore. But this melt up will go on because we both agree. They will print. The ECB will print. The Fed will print. The Bank of Japan, the Bank of England, they all will print till the end. It's just the insanity of the end game. So what do you think about real estate? Is it a safe haven? Is it one way to protect your purchasing power? Will it melt up more than perhaps stocks or gold? Or what's your point on this?
I don't think it will melt up as much as stocks, and I definitely don't think it'll melt up as much as gold, right? If you look back to after World War I, by the time all was said and done, you could buy a city block in Berlin for an ounce of gold. So, real estate went up, but gold went up a lot more. Historically, when sovereign debt bubbles burst, gold goes up, everything else goes down against gold. Everything goes up, but everything goes down against gold. So, but for real estate, for me, we're sort of in this weird time. I don't know if you guys are seen as there as well. I suspect you are, but because of some of the technology developments, but then also some of the unique or some of the social developments here in the United States, I think real estate is a good investment, but I think it is much more, maybe going to be more specific than it has been in the past. What I mean by that is, in America, we've had this big move back into the cities over the last 15, 20 years. I think that's going to start reversing.
Over. Exactly, it's over.
And so that is, okay, do I want rural? Do I want lakefront? Do I want, what type of real estate? And then the other thing too is the technology side, right? In terms of what Amazon is doing to historically very productive storefronts, commercial real estate. That's the other thing you have to be mindful of. So for me, I think real estate is still a very good store of value, but I think it is going to be much more about location and type, very much more of a niche investment rather than what it's been for the last 40, 50 years, which is you could basically just buy big real estate portfolios and you generally end up okay.
Yeah. It's also a paradigm shift we see there right now. What about stocks, equities?
I like stocks. I don't, and I own, the valuations are crazy. But for me, it is really, unfortunately, it's intellectually offensive, but it really comes down to, we have this chart that shows the U.S. total equity market cap, right? So the total equity market cap of the United States stock market. And then we take that chart and we adjust it for total federal debt outstanding, because my view is eventually the Fed's going to have to print the money to buy virtually all of that. And what this chart shows is after 2000, where valuations were totally crazy, once you adjust U.S. total equity market cap for the debt outstanding, stocks are expensive, but they're not that expensive. In fact, we've added so much debt that's going to need to be monetized, in my view, that stocks could go up 30, 40, 50% from here just to get back to, call it, 07 peaks, and they would have to double or more to get back to the 2000 debt adjusted peak. And so it's really a way of saying, because we've added all this debt that's going to have to be monetized, I just want to own assets that are more finite, that are, especially with rates at zero, I just would rather own more finite stakes in valuable property or valuable businesses as stores of value. And for me, I want to own industrial equities, and I also want to own tech equities here in the U.S. I think we'll both do well. But I think you also need to start looking at those same types of properties, same types of equities, in Europe, in Asia, because I do think you want to get, some hedging of the dollar. So I think you basically, global industrial tech equities, I think is the way I would want to play it.
Okay, perfect. What do you think about gold and silver, and perhaps with a price target?
I love gold. It's my favorite asset. I think gold is, I think in the next, by this time next year, you could see it $2,500 an ounce, maybe more.
Okay, we will talk, man.
I think that's probably a nice conservative price target. But I also do think with gold that you have an optionality much higher, where I think at some point gold has this optionality that no other asset has, which is gold is the number one asset on the central bank balance sheet basically everywhere in the world. And what we're talking about with this bursting global sovereign debt bubble, they can do certain things, they can print, they can, in the end, we know how this ends, which is the value of that gold is going to have to be written up enormously to basically recollateralize central bank balance sheets. And so that number to do that is not $2,500. That number to do that is probably $7,000 to $20,000 an ounce. Now, that's not my price target, but that's where I think that optionality exists.
Possible.
So it's possible in a crisis situation. So that's why I like it as much as I do. And I like it because I think it's going to have some role as a neutral settlement asset in this new currency system, which again, as that happens, it has to be made much bigger.
Definitely. What about silver?
I like silver as well. I think silver will do fine. I own some silver.
Better than gold?
What's that?
Better than gold?
No, I do not like it better than gold. And the reason I don't is because silver is not on central bank balance sheets. And
not
so
yet.
I think not yet. It might end up being, and my view would change if that actually happened. I think ultimately, if gold's at 2,500 a year from now, I think silver would actually probably have more percentage upside. And so my view is a $2,500 gold move in gold. The system's still going. The system's still working, right? Where I think gold ends up outperforming silver is in what I think will be the end game, where there's a monetary conference, we come out of it and gold is 7,000. And in that case, I think if gold's 2,500 a year from now, silver's 35. So you call it 50% upside versus 20% upside for gold under a sort of a normalized situation still.
Reasonable.
If we wake up in 12 months or 18 months and gold is 7,000, I think silver's 50 or 60, right? So there's that upside, but not as much as gold. So I think it depends on the views, how quickly you think some sort of reset or revaluation of gold to recollateralize the system is needed. But I do like silver. I like silver a lot.
Yeah, perfect. What about commodities?
I like commodities. Ultimately, as we've been in this period of time where you can see commodities values in dollar terms relative to other financial assets have just been going down and down and down and down. And we've been talking about for a long time that as this new currency system transitions, where you go from just all commodities priced in dollars to commodities being priced in other currencies, as that happens, it becomes increasingly important factor in commodity prices in dollars is what's the dollar doing against the euro? What's the dollar doing against the yuan in particular? Because as the marginal barrel of oil is priced in euro, priced in yuan, the euro dollar cross rate starts to be more important. The yuan dollar cross rate starts to be more important. And so ultimately we've had this strong dollar over the last 3, 4, 5 years as this currency or commodity currency system has been transitioning. And I think this has been capping commodity prices, strong dollar, low commodity prices. Now that we're seeing the dollar weaken, we're seeing all of a sudden commodities start to get a little bit more of a bid. They're breaking out. And I think ultimately, today, because of the things we talked about earlier in terms of this really getting into the acceleration of this end game where the U.S. really does have to monetize more than other people by virtue of our past and ongoing deficits, I think it's going to continue to be all else equal, a weaker dollar relative in particular to the creditor countries, the euro, the yuan, the yen. And as that happens, I think that's going to be really good for commodity prices in dollars in particular. So I do think we're getting to a point now where commodities are they have been getting better, but I think they're going to continue to do well.
Okay, perfect. What about mining stocks?
The gold miners?
Gold, silver, uranium, platinum, everything.
Everything. I bottom line is I like them all. I think a lot of the non-precious metal miners, I think, have suffered from the dynamic I just discussed in terms of this transition to the monetary system that now seems like we're getting more critical mass. And so I think they're going to probably continue to do well as long as the dollar keeps weakening. And gold and silver miners I really like. I think ultimately they've been very disciplined with capital. They have you're running into supply issues when you look at the relative rates of supply. And so you're running into, they've been very disciplined with capital. They've been very constraining of new supply. And we're running into a perfect storm on the monetary side, on the fiscal side. And so to me, I've got, I think, probably about 10% of my net worth in gold and silver miners.
Which one is your favorite? Just tell us one.
I like the big one. I mean, Agnico, Kirkland, Barrick. I've got Newmont. Sort of those are like my biggest. Just through the the big cap. I don't do much in the smaller ones. those are the ones that are in my portfolio through a fund that I own. And
there's still 5 backers or 10 backers, I guess.
Yeah, for me, the big thing I always tell people is I think it's political jurisdiction will be very important to understand where your gold miners mine. And
Definitely.
I think you want to
very
protect
important.
protection of law, because if we do wake up in gold 7 or 10,000 an ounce, you want to be in a place where the government's going to let you keep most or all of that. And
not in Venezuela, not in Bolivia, not in Peru.
No, you may not get to keep all of that.
Exactly. So last but not least, Bitcoin, the digital gold. What's your take on this?
You said it best. To me, I've seen it as digital gold. It's a fascinating construct to me because it really is. It is an energy-based currency. It is, it's based on, to me, a store of value, and I should say a store of value more than a currency, but an energy-based store of value is the perfect store of value, because ultimately you are then, to me, money is a manifestation of work. Store of value, you can never get your time back, so you want something to store the work that you have done. And the energy inputs to Bitcoin basically are providing the backing to the value of Bitcoin when you talk about the proof of work dynamic of it. I think that it does a lot of things that gold does, except that I think it does that better than gold in a lot of ways.
Yeah.
And people like Michael Saylor and Preston Peisch and a number of others have talked about how that is true. To me, the one thing gold doesn't do better, the one thing Bitcoin doesn't do better than gold is that Bitcoin is not on central bank balance sheets, at least not yet. And so if the central banks, the break glass in case of emergency, button on the side of the central bank wall, that involves gold. That doesn't involve Bitcoin. And so I actually think there are scenarios where I think under a status quo scenario, where gold 2,500, silver is 35, I think Bitcoin outperforms them both. But under sort of, we come to this all comes to a head and we have the big part of the crisis. I think there are scenarios where gold outperforms Bitcoin, but that outperformance, if that happened, would happen all at once. In other words, monetary conference, we go into the monetary conference, gold's at 2,500, 2,600, whatever, and we come out of it and gold is 10,000. And then you go, okay, now that's happened. I want to redeploy my gold. I'll sell my gold to the central bank. I'll take their currency at that point, and now I redeploy into other assets, some of which could very well be Bitcoin, because I really think Bitcoin is basically the neutral reserve asset for the people.
Wow. Okay. So you've got a price target for the next 2 to 5 years for Bitcoin?
The guys that I respect most on it, I would totally defer to them. They're saying here could be $100,000 in 2 to 3 years. And
yeah.
Possibly
and everybody.
To them.
Okay, crazy. So how much of your net worth do you have in Bitcoin, or would you invest in Bitcoin, or would you recommend?
So I've got right now, I think 2 to 3% of my net worth in Bitcoin. Okay. So for me, it's the volatility, and then just there's still some things here in the U.S. in terms of, the New York Attorney General is looking into Tether, for example, the stable coin that helped. There are issues there that, as I've said to my clients, I'm at 2 to 3%. Intellectual honesty and integrity dictates that I say, look, I'm not a lawyer. I don't know how this could work out. It's probably nothing. However, there is that headline risk where you wake up one day and Bitcoin has been cut in half. Yeah. If it was cut in half, I'm probably a buyer, but I don't want to have that happen with too big a chunk of my net worth at this point, is where I come out on it. That's how I've thought about it.
No, you always have to have a diversified portfolio with different assets, because Bitcoin is a new asset and it's very volatile, and sometimes you have a dip with 30, 40, 50%, or even 80%. But in the past, it was always a good thing to buy it when it dipped. So yeah, we will see. So how much do you have in gold and silver, for example, of your net worth?
Gold and silver, I'm probably all in, probably 40%.
Wow. Okay.
Maybe more, maybe 40 to 50%. And it really comes down to the more this has developed.
Yeah.
It is crystal clear to me. We are in the first global sovereign debt bubble in 100 years.
Definitely.
And it's bursting. And historically, gold beats everything in that scenario. And you really want to own assets. You want to be overweight assets that are nobody else's liability, right? Yeah. If I own a piece of debt, somebody else has to pay me. And we're seeing it, right? In America, I don't know if you've had those there. I suspect you probably have. But in America, they have put in moratoriums on rent, right? So you own a rental building. You say, well, gold doesn't yield anything. Well, you're right. My rental building yields me something. You're right. Well, now your rental building is not yielding you what you thought, or not yielding you anything, because your renters don't have to pay rent because of COVID, but you still have to pay the taxes on it. So you're so I think, in when you read the history books of these once every 80 to 100 year fourth turnings, all bets are off the table. Like everything you thought you knew, a lot of that gets completely thrown away. And so to me, where that brings me back to is I want to be overweight assets that are nobody else's liability. And that's physical gold, physical silver, Bitcoin. And then the list gets really short. I think there
diamonds.
What's that?
Diamonds.
Yeah, diamonds. Yeah. Yep. That's right. There are, it's, so to me, that's where I want to be. And I think there are price, if you find the price target, I always have other assets I would love to swap into from there, but at the right price.
Definitely. Yeah. There will be a chance. Don't worry in the future, but right now we're in the paradigm shift and everything will change. I totally agree with you. We will never wake up in the old world, and there are exciting times ahead of us. My last question to you, Luke, is what is for you the sense of life?
What is for me the sense of life?
Yeah, because right now we talked about money and all the superficial stuff, real estate, gold, Bitcoin. But what is the sense of life for you? What's when the last day of your life, when you look back, what do you think was the most important thing you achieved or you experienced?
Oh, it has to be my family.
Beside our conversation, of course, but
yeah. I'll look back and it's December 8th, 2020. I'm like, you remember that conversation with Mark? Yeah. Your name will be the last words to leave my lips. My wife will smack me on my deathbed, but
okay, but it's your family. It's your family, you said.
It's my family. Yeah, okay. I'm married to my high school sweetheart. We met almost 30 years ago, and she's just tremendous. She's a great, she's my best friend. So that's, and then we have 3 beautiful boys together. We got a 19-year-old, a 17-year-old, and a 14-year-old, and FFTT is my business. So, my oldest is a rower, so I've been able to go to virtually all of his rowing events. And my middle one's a baseball player. So in baseball season here in America in the summer, I last year, I think I went to 60 of his 62 baseball games. And the only 2 I missed was I was at another one with an event for one of my other sons. And then my 14-year-old, he does a little bit of everything. He runs track and he does artwork. And so it just, spending time with them and really watching them grow into young men, it's incredible. Just incredible.
The best investment, the best return on investment. It's with your family, with your friends, and with your kids. Awesome. Luke, it was a pleasure talking to you, and the time just flies. It was incredible. I hope you enjoyed it as well. I hope our audience did it. And I just have to say thank you. And I really appreciate that you spent all the time and all your wisdom with us. It was amazing.
Thank you very much for having me on. I hope we get a chance to do it again. It was an absolute blast. I really enjoyed it.
Definitely. We will do it.